So there are many map tricks with indices sometimes. Okay, they add and they remove certain companies, like the Dow Jones Industrial. Okay, most of the 30 largest industrial companies. Okay, so when somebody talks about the market, they always say, "Hey, what'd the market do?" It's always the Dow. The beauty of it is that what you're also going to see is the more diversified you are, the more you're going to be able to ride out any storm. The retail investor needs to understand that you're much better off aligning yourself with a true professional and be diversified. The reality and the statistics are as follows. These are the stats. Over 90%, and I'll even say as high as 95% of people who try to invest themselves by clicking a button or trying to be a day trader lose all their money. No one's ever gone broke taking a profit. All right. So people always justify, you see, the brutality of the market is this: numbers don't lie, people do. The Chinese bought the LME. Okay. And when they bought the LME, there was a big manipulation in the price of nickel. And it gave the exchange a really, really, really bad name. And a lot of people started to move away from that exchange, okay, because it does trade. You have to be a member to be in the ring there. And the biggest members are, the Barclays, all the big boys. Okay, the seats are very, very expensive. But point that I'm making, all right, what the public should also understand is that if you lose faith in an exchange, then you're going to lose faith in the market. What's called the rise of the machines. Okay, the rise of the machines. Okay, all right, because believe it or not, over half the transactions that happen in the global stock markets happen away in dark pools and in other venues. Very interesting. The markets get efficient. People get efficient. That's why every market gets efficient. That's why it's a market. Okay, and as it gets more efficient, it becomes much more complex. When you saw, all the properties that had problems in China, obviously they're worth something, but to who? All right. And those are the complex things about property. If there's $1 in your checking account and you write a check for $5, your debit $4. I mean, your overdraft. The world is basically overdraft. There are very few countries that aren't overdraft. When there's a disconnect between Main Street and Wall Street, it's the little guy who feels the inflation. Even the big guy feels the inflation. All right. If you're a big property owner and you're in an adjustable rate, okay, and let's say the property is worth, 50 million and you're in an adjustable mortgage rate, that extra 3/4 of a point or a half a point could kill you.
I'm your host, Farzin Irani. Let's connect the dots. Our guest today on Connecting the Dots is Steve Lawrence, CIO of Balfour Capital Group, and he's here to discuss the current state of money and markets. Welcome to Connecting the Dots, Mr. Steve Lawrence. It's a pleasure to have you on the show today.
Farzin, thank you very much for having me. I'm really excited to speak to you about the markets in general.
I'm honestly, I'm the one who's excited because people like you get interviewed on the New York Stock Exchange and obviously around the world. So I just have to say, honestly, it's a pleasure to host you and pick your brains on what's happening in the markets. And the world's moving so fast every single day. So we have you here just to make sense of it all. Where would you like to get started, Steve?
Well, I think the viewers should know a little bit about who I am and my history and how I started. Okay. I started on the floor of the Chicago Board of Trade in 1989. Okay. So, I'm 60. And when I started my career in the very beginning, the stock market just crashed in 87. So it was very difficult to find a job, and virtually impossible. And I went to school in New York, but I'm from Chicago originally. So I had to go back home and my dad owned a delicatessen down the block of the Chicago Board of Trade. And in the morning time, okay, uh, my father had a busboy who used to work for him. In the morning time, this busboy would work at the CBOT, and in the evening, okay, he worked for my dad. Okay, and my dad was an old timer, Abdul guy, and his name was also Steve. And he used to say to him, Steve, when you make it down there, don't forget about me. Okay, don't forget about me. So I come back home from university, and I'm literally standing behind the counter because all the big traders in those days used to come to my dad's restaurant. My dad's a restaurateur. He's not a trader. Didn't know much about finance. Okay. So now this busboy is a client of the restaurant. And my dad says, "Don't even, my son, this fancy degree he has, he can't get a job anywhere. Steve, can you help him out?" He says, "Absolutely. Tell him to come down to the floor 5 o'clock in the morning, okay, 5 a.m. in the morning, and he's going to start working for me." Unbeknownst to my father, I'll never forget my first day of work. I'll never forget it till this day. And he's a super nice guy. I knew the guy. I mean, he used to work for my dad. Okay. Uh, I'll never forget it. First day of work, he says, you're not going to say one word to me for a week. Not a word. Not one syllable. I'm going to give you a piece of paper. You're going to take this piece of paper from here and bring it over there. Not a word. I'm like, oh my God, I went to college for this. Okay. All right. Starting at 100, at 200 US dollars a week. And I had a fancy schmancy degree, whatever. Okay. Because it was a different language. But unbeknownst to my dad, he was the fifth largest bond option broker in the world. So his customers, okay, were like Goldman Sachs, Bankers Trust, UBS. They would call down to the floor and they would do these very, very complex transactions. All right, in options. And I started there and then I went from there. Okay. And then I became a phone clerk and then I ended up working at Cantor Fitzgerald. Okay. I used to cover Howard Lutnick, the Commerce Secretary. Okay. Before he was president and CEO and working directly for Mr. Cantor. So I became friends with him on the phone.
That's your claim to fame, Steve?
I mean, I wouldn't say it's my claim to fame. Okay. I'd say my claim to fame is, it's a marathon, not a sprint. Managing a $500 million and having, brick and mortar locations just about all over the world. I've really seen the transformation of markets in general. I mean, the true transformation of the speed, the electronic execution, just it's on different levels. Okay. Chicago's a powerhouse for electronic trading. It's a powerhouse. That's where Citadel. I mean, they just moved. The Honorable Ken Griffin, okay, who runs Citadel. Where do you think he's from? He's from Chicago. Okay, that's where Citadel was based. I mean, so you've had some massive uh, institutions. Even Jamie Dimon was based in Chicago before. Okay, he became CEO and president of JP Morgan Chase. He was at a bank called Bank One. And he's under the tutelage of the Honorable Sanford Weill, okay, who changed the world uh, in the insurance industry. So it's a really interesting career. And I think I can bring a lot to the viewers of understanding risk and understanding the markets.
There was something I want to pull on, the thread I want to pull on there. There's something you said, which is because you've been through these markets and you spent your entire career there, something you mentioned back in the days, the tickers, it all used to be journal entries and calling people and stuff. And now it's something that used to take a day for settlement, might take only a few milliseconds. How do you see that transition that has happened and how has it impacted markets positively or negatively?
Okay. Great question. Okay. Uh, you know, in the day, in the 90s, early 90s, the trade settlement for stocks, okay, would be trade date plus 5, T plus 5. So that means Mr. Jones, okay, could call his broker, buy 1,000 shares of IBM, and he has 5 days to pay for it. 5 days. Okay. All right. Now, Okay. I mean, 5 days. I mean, that's,
It's
you're
crazy if you think about it in today's terms, right?
that's how, and then it went down to T plus three. And in derivatives, the money has to be there prior. Okay. So when you're trading futures and options, the money needs to be there prior. There's a reason for that. Okay. Because of the volatility. All right. Remember, at the end of the day, the clearing bank, all right, can't go debit. Your account could go debit, God forbid, and then you have to pay the difference. Okay. But it cannot go debit because the clearing bank is on the hook. All right. And I've seen clearing banks go down. I've seen the sterling at 202, gold at 285, and the euro at 97. Okay. And the world didn't crumble. Okay. I've seen interest rates at 11. All right. I've been around a long time. I mean, in the day, they used to cut rates by not a quarter, you know, by 2 points, 2 percentage points. Yeah. So markets get efficient. So do people. Okay, with technology. And I think the viewers have to realize that. I mean, all over every market talks to every other market. They do. It's like the human body. Your finger talks to your wrist, talks to your elbow. Okay, talks to your shoulder. Okay, it's the same thing. There's relationships between the ASX, the DAX, the Nasdaq, the CAC 40. I can go at the Merval. Everything talks to everything else.
Exactly. And the show is called Connecting the Dots. And that's exactly why we have you as well, because you'd be able to explain to our audience that what we'd call a butterfly effect in Hollywood terms, if something's happening in Brazil, it could affect something else. And supposedly a tweet from Trump could affect a certain currency somewhere else or another market somewhere else. Um, Before we go, because we'll go on specific markets and cover all of that, you mentioned market volatility there quite a few times, right? Obviously, because you being a hedge fund as well, you've got to keep a close eye on these kind of things. How do you guys, or how do you yourself, Steve, handle market volatility and kind of try and balance risk and reward? Because obviously, the higher the risk, the more the reward, and vice versa. How do you guys try and manage to do that?
I think that the viewers will always have to understand this. You can never ever, and this is a general rule, and I ask this to every client. Okay, and it doesn't matter what. And I have clients that are worth hundreds of millions. All right, and then I typically work with people who have a net worth of a minimum of a half a million at minimum. Okay, liquid net worth. The first question I always ask them is this: aside from making money, what's the most important aspect in any investment strategy? Doesn't matter what it is. Okay. And I always wait for the answer. And there's only one answer. There's only one answer. Okay. And it's never how much you can make. It's always how much you can lose. And to understand that, okay, you have to realize it's about risk reward. It's just a tenet of life, if I'm going to get married, what's the risk involved? Am I going to get divorced based on this?
That's a funny one there, Steve. Yeah, exactly. People could get divorced over these kind of things. Yes.
And you'd be very surprised, okay, what people say. All right. And it's really about how you manage your own personal risk. Okay. If you want to bet on black, you're better off going to a casino and doing one bet. You got a 50-50 chance. All right. Okay. But investing is not about that. Investing is being diversified, understanding yourself and what you are willing to take. Okay. And I can give you so many examples that you should see. So the volatility can work for you and against you. All right. That's why when you work with a professional like myself, uh, it's much easier for me to explain something what I do is complex, because if it was easy, everybody would be doing it. And it's not. It takes a lot of work, it takes a lot of dedication, and it takes a lot of research. And it also takes a lot of patience. Okay, the key is
It's funny you said that. Sorry, I didn't mean to interrupt, Steve. It's funny you said that because we both being in the finance industry, exactly right. People come to us because we have certain finance hats and we know certain things that we know. And I tell some of my clients, I'm not going to go to an Uber driver and ask him to perform a heart surgery on me because he's not an expert at that. So the whole point in today's world, people got to realize you go to an expert and you get the expert opinion, and you have to pay for those kind of fees as well. I think in today's world, with all of these apps that have come out and everyone wants instant gratification, they think it's easy. Or let's just buy GameStop or something like that. When we saw what happened during COVID, and then unfortunately, the retail buyer comes in at the last minute, I think, because he doesn't know what he's doing. He gets caught up in the frenzy, whether it's that or whether it's, I think Bitcoin also, the retail buyers get in at the wrong times. It's not just about the asset type, but it's also what time do you get in and when do you know how to come out. And I think that's where we need people to understand. You need professionals for that exact reason. And because you said it's risk and reward, you don't want to lose your shirt trying to get in too late and being chucked out of the market. So
And I couldn't agree with you more. Okay. And I think to even take it, to the next level for the viewers, um, there's a real basic tenet that people tend not to understand. When a customer asks me, what's the best investment I can make? I go, why are you asking me? You know what the best investment is. Yourself and the business that you've made money in. Okay. All right. And I always tell them that. And they always laugh when I say that, but there's so much meaning behind that. You see, when you're managing money professionally and someone's giving you their capital, their hard earned money that they earned, they want it to grow. Okay. All right. But they can't rely on that. They can't rely, they've made money in their life because they focused on their business. You see, when you're looking at the markets and when I'm looking at the market, literally 24/7, or literally, I'm at my desk at 2:30 in the morning Eastern time, and I go to bed at 7.
wow.
It's the life I chose. Okay. Because number one, we manage a substantial amount of capital. All right. Number two, in order to have a competitive advantage, I'm watching a soap opera all day. That's what CNB, what you need to, what I think the public doesn't realize this yet. Okay. Um, the media, and there's only who controls the genre of the market, the genre. Okay. All right. CNBC globally controls the genre. They do. Okay. Whereas Bloomberg, for example, they're more about hardcore data. Okay. Hardcore data. Okay. And you'll always see that CNBC always gets the biggest players on, always consistent. Okay. So they control a large part of the genre. And all the other outlets, whether it be Reuters, Asia Financial Times, and they're London Financial Times, the Wall Street Journal, they're on a different skew. Okay. But CNBC really does control the genre, the media, of the focal points of the market.
You mean the shop front, obviously, what gets out there.
The entire, you know, global aspect. Just look at not only the viewership, all right, it's who they get on. Okay. Warren Buffett, he may go on Bloomberg maybe once or twice a year. Okay. All right. But they get Buffett on, they get literally the largest CEOs on there all the time.
I think I've seen a couple of your interviews on CNBC as well.
Yes, I've been on CNBC in Singapore, various channels, and they get called back because I'm very direct on I go out there and I make a call. I say, I believe this is going to happen and I own it. And I document it.
Which is very rare in today's world, because when we ask people to make a call, they'll sit on the fence and they'll say, oh, if this happens, then maybe this. And if this happens, then maybe this, as compared to picking one or the other.
Yeah, well, you'll see that in the real world, okay, and when you have to actually make the transactions, you own it. You can't take it back, okay? And you just do. I mean, it is what it is. But going back to this main point that he made, and I think we gotta emphasize this, okay? It's all about being diversified, you know? All right. It's about being diversified. And by being diversified, you have to have some stocks, some ETFs, and you have to have specific stocks, okay, specific indices. Um, and then you can ride the storm. Okay. You can ride the storm. and there are always going to be storms in the market. I remember once when they thought Gorbachev got shot. Okay, I was on the trading desk. Okay, on the institutional side, and the market, and I'll give you a comparison. Um, at that time, it was the Deutsche mark. It was going down by percentages, percentages, 1,000 ticks, 1,000 ticks, 1,000. Okay, right, and it was a different world back then, and you do see this type of volatility even today. All right, relatively shortly. Okay, the Nasdaq and the New York Stock Exchange, I believe at the end of next quarter will be going 24/7, 7 days a week.
Okay.
And 7 days a week. Or That's going to change a lot of complexities. The markets are all connected. Every one of them. Every one of them.
They are, aren't they? Because sometimes also, um, I used to watch the price of certain commodities, let's say things like gold and silver, and certain markets shut off. And let's say the Asian markets open, and suddenly I would see a slight spike in the price of gold because the Asian markets might see it differently, whereas the COMEX might see it differently again.
I'm an actual myself and my partners were members of the COMEX, the Metals Exchange. We have a seat, okay, through the Chicago Mercantile. So I look at the metals religiously. Let me explain to you one thing about the metals market, gold in general. Okay, gold's the most liquid asset in the world. You can you can get a price on gold at 2 a.m. in the middle of Kuala Lumpur and actually get out, okay, in the physical market. All right. No, and I'm being totally, totally serious. It's a market that has still today a big psychological effect, even today, and I think the public realizes that, and they
Do
do. I
you
mean,
can I ask you, Steve? Do you think the market realizes that even in the West? Because I know in East, and I spend a lot of time in Asia, and I was raised in India, and that's why I ask you. In the Asian economies, gold is seen as a real wealth asset. It's gifted at weddings, and people store it. Is it because it's just been in the psyche, and obviously in Eastern democracies, people have not trusted their governments as much, or is it because they've seen their currencies being hyperinflated away or inflated away, and that is why gold is held, whereas in Western countries not so much? I don't think the Western media highlights the role of gold, and you highlighted that perfectly. It's the most liquid asset in the world besides the US treasuries of the US dollars.
well, let me say this to you, okay? You'd be very surprised who has the most gold.
Yeah, the ones who tell you not to have it are the ones who have the most gold.
The United States of America has the most gold by far. Mhm. And you would think a country like India would have a lot of gold. Okay. They're about eighth on the list. Right. All right. So it's very, very, very interesting. You have to understand that gold, just in general, okay, in all societies, gold has always had value. Look at the history of gold. Remember, the markets started in what form? The commodity markets. Commodity markets started though. I mean, why? How did derivatives start? Okay. A guy hit some corn in the ground, he grew his corn. All right, he wants to make sure that he can bring it to market and he can lock in a price. So he owns the physical in the ground. He goes to the exchange. He sells a contract. So if gold goes up, he has the physical, and then if corn goes down, he covers his short. He's locked in. That's called the hedge. Okay. Everything you see today. I mean, and people don't realize that the most sophisticated markets in the world are the agricultural markets because they started the markets. How do you think the Chicago Board of Trade and the CME came together as one? Okay. They were two rival exchanges. Okay. The CBOT, okay, had all the grains, the corn, the wheat, soybeans. Okay. And then they went into other derivatives like the bonds. Okay. Whereas the CME, okay, They had all the meats, the pork bellies, okay, live hogs, okay. They were hedgers for that. And then they, okay, outmaneuvered the CBOT by creating the S&P 500 contract, the NASDAQ contract, the front end of the yield curve, the euro dollar deposits, okay, and the currencies. All right. So spot people who were trading physical currencies would use CME, and then they merged as one. Okay. And it's a famous story during 1987, when the stock market crashed. The first call that the New York Stock Exchange made was, "Are you going to open the next day?" To the CME, to the CME. All right, because back then, you know, they were using the CME, all right, to hedge on the S&P 500. R- And they did. And one of the reasons what makes the Chicago Mercantile Exchange so powerful is that they were cutting edge technology, cutting edge, cutting edge of technology. And they really developed that and many of the exchanges have mimicked that, okay? Many of all right? They use the systems of the CME, all right? Because intertwine the CME is one of the few places in the world, okay, that you can hedge electricity on. Few very, very that you want a volatile market, okay? Just to trade one electricity contract, you have to have 500,000 on hand. In just one. The big boys, they trade 100 lots, okay, and they move in percentages.
And that's the world of big finance, right? Obviously, the everyday mom and pop doesn't understand what's happening behind the scenes. You could go to sleep one night, and obviously, there's a long or a short in one place which would go horribly wrong for a big organization or an investment bank, and you might wake up to a totally different scenario in the morning.
Of course, and it goes back to being diversified, okay, and one of the things that's really critical, and I give people a real scenario, okay? Let's assume you just love Johnson& and Johnson, the company. Everyone knows Johnson& and Johnson, right? You only have one stock in your portfolio, Johnson& and Johnson. And on a Friday, okay, after the market closes, you own the stock at 160, okay? And they come out with an announcement that says anyone who's taking Tylenol, you will get, God forbid, cancer, all right? On Monday, that stock could be at 5,
Yes.
okay? Could be at 5. And that happens all the time in the markets when they come out especially uh, in in certain sectors like biotech. If they don't pass an FDA or tech in general, all right, people have very short-term memories. Okay, very short-term memories.
They do. In fact, let's go there because you mentioned something about the S&P 500. Now, obviously, that's reaching new record highs. Do you think that's because, let me rephrase this as in, do you think, what is your thought on it? Is it strong corporate earnings? Is it investor sentiment? Or is it just the risk appetites are getting more to a higher level? Or do you think there's actually underlying economy which is pushing this where it is?
Okay, just to the public, if they don't know what the S&P 500 is, I'm going to explain it to them. Okay, it's the 500 most powerful companies that join this index, and they're each weighted at a certain level. Okay. So there are many map tricks with indices sometimes. Okay. They add and they remove certain companies, like the Dow Jones Industrial. Okay. Most of the 30 largest industrial companies. Okay. So when somebody talks about the market, they always say, "Hey, what'd the market do?" It's always the Dow. Okay. All right. Believe it or not. What'd the market do today? All right. It's really not the S&P or the NASDAQ. It's what the market. So the biggest sentiment is always the psychology of the Dow. All right. But getting back to the point of what the viewers need to understand is that by owning multiple stocks or multiple ETFs, what's an ETF? It's a composite of of certain weightedness of various sectors. And the beauty of it is that what you're also going to see is the more diversified you are, the more you're going to be able to ride out any storm. Okay. And when I said people have short term memory, 2 years ago, Meta, Facebook, okay, was at 87. Now, prior to that, it was at 350. So think about that. It went from 350 to 87, and it's at 700 and change right now. Now, obviously, just imagine someone who owned Meta at 350. So the guy bought 1,000 shares at 350. Okay, at 350,000. Okay, 7 months later, it's worth 87,000. That's called pain. Okay, that I mean, that's a big nut. I mean, and the moral to the story. Okay, you can't be woulda, shoulda, coulda. Okay, meaning if you held on to it, now it's at 750.
You doubled your money almost. Yeah. Yeah.
Yeah, exactly. But they took pain to 87.
That's what I mean. The market psychology, unfortunately, is when it starts dropping,
It's no psychology.
yeah, the average investor just gets out because he just wants to cut his losses short. And then when it rides back up, now it's double the pain because it's like, oh, if only I was stuck in there and didn't panic. And this is why I mean the smart money knows what's going to happen, or they can see the trends and they play it and they get rich, not the retail investor.
The retail investor needs to understand that you're much better off aligning yourself with a true professional and be diversified. The reality and the statistics are as follows. These are the stats. Over 90%, and I'll even say as high as 95% of people who try to invest themselves by clicking a button or trying to be a day trader lose all their money. They just do. Okay. Because I'm going to be in this transaction for an hour. Okay. And then suddenly now he justifies, oh, now I'm going to, it's a good play. I think now his turn, now he's a long-term player in something or when he sells something too early, the justification is this, no one's ever gone broke taking a profit. All right. So people always justify. You see, the brutality of the market is this: numbers don't lie, people do. And what you're going to see is how things are always forecasted. You see, what really fundamentally changes in a company in 15 minutes? Typically nothing. But the market may think something's going on. Remember, these are companies. And what makes great companies? Great people. And you've also seen great companies go down. I mean, amazing companies. Whoever thought? I'm an old timer. It was a company called Sears Roebuck. Okay, you know, they created Morgan. They created the charge card. Okay, which was discovered. They actually founded Dean Witter, which is now Morgan Stanley. Or And they had the largest real estate portfolio. They owned the Sears Tower, which is now the Willis Tower. Their real estate portfolio was massive, and they ended up going bankrupt. And they started before that. They started in the 1800s. Okay, late 1800s, doing mail catalogs.
Yes, I remember that. I remember the catalogs and all that stuff.
And when a company doesn't adjust to the new times, okay, that's what you're going to see.
Like your blockbusters of the world when Netflix came along and stuff like that, right?
Absolutely. I mean, they were at not first. They could have been the biggest in streaming. Look at right now what's going in the media industry, which is fascinating. Cable TV, satellite TV, people are streaming. They don't need to have cable. They don't need, and you're seeing that all over the world. All over the world.
I think COVID changed that as well because people were sitting at home. Consumption habits have changed with the booking everything online, the Ubers, the Uber Eats, consuming at home, working from home culture. That's changed a lot. So while we're on that topic, Steve, can we talk about? Obviously, this is a nice segue into the artificial intelligence, and what are your thoughts on how is that impacting today's markets and also different geographies and different parts of the world, whether it's to do with an economy having a higher GDP or people losing jobs. Take it wherever you'd like. Your thoughts on AI.
All right. What is AI? Okay. When someone says, what is artificial intelligence? Artificial intelligence is a fancy word for an algorithm. Okay. That's what it is. It's an algorithm. Okay. There's always new words that come into the market. Okay. All right. So what you're seeing is, and I'll go over these things. Okay. Because that's 65% of what I do is algorithmic. Okay. 35% is human. So I am writing algorithms saying, what's the relationship between PHB Billiton, Rio Tinto, gold, silver, and 25 currencies, for example? What's the relationship between British Petroleum, Shell, Total, BP, the price of oil, and stock index futures? Okay, so everything, the relationships, okay, 65%, that's what I do. I look for relationships. 35% has to be human. You have to tell the machine what to do, okay? You have to tell the machine what to do, and you've got to really simulate things on what if what if this happens, this could be the outcome. There's no holy grail to the market. There isn't. Getting back to the basic premise with AI, okay? AI right now is making the world faster and more transparent. But what you're also seeing is this: you have different components within AI. Okay. You got the chat GBT versus Grok versus, there are different companies. Okay. All right. That are out there. Okay. So what you will see, okay, with a lot of confidence, you will see this. You're going to see that there'll be interfaces that'll talk to all the AIs at the same time.
Okay.
There'll be an interface where there'll be an API, all right, that will there'll be someone will come up with a company and they're doing that right now. And now the next new word that's coming out right now is quantum computing. There's always the next word. Okay, what's quantum computing in a very simplistic way? It's a much faster computer chip.
Much faster computer. And that's why, obviously,
What
yeah.
is it? It's a much faster computer chip, okay, that is reliant on a lot of electricity and a lot of so the market always comes up with the new story. That's what markets are.
Can I ask you a question? There's something I've heard a couple of market commentators recently talk about is these data centers and stuff. It's not only going to need a lot more electricity, but also a lot more water to cool down these data centers. And is that even counted in as the next big commodity? Because there's some companies out there that are buying up streams, a sector no one's talking about, water.
Listen, the point well made, okay? Uh, Quebec, okay? Like, 70% of the time I'm in Canada, 30% of the time I'm in Chicago, and I got a place in Florida, whatever, okay? I'm like, but the point is, in this province, they sell electricity. And how do they sell electricity? Because they're surrounded by so much water here. All right. So point well made. Okay. And as you see the consumption of electricity, okay, and listen, you can't build a data center without copper. You can't build anything without copper. You cannot. I mean, copper is that's why when you saw copper, but it's the truth. You cannot. Copper has always been a big indicator. You can't build a data center without copper. You can't build a building without copper.
And copper's been going up recently, hasn't it? Which tells you they call it Dr. Copper for a reason.
Yeah, I mean, and that's when you saw the power of how stable one of the exchanges was. When it went down the most in the history in one day, it was about 3 weeks ago, where copper really got hit. Went down like 12, 13 in one day. Okay. And every transaction cleared perfectly. All right. Because a lot of people lost a lot of money if they were on the wrong side of their transaction.
But can you correct me if I'm wrong? Now, this is just off the top of my head. Was it a year and a half back, 2 years back, that the price of copper went up so high that they actually shut off the exchange and then nulled and void some people's contracts?
Well, what it was actually in nickel. There was a big problem.
Oh,
There
yes. Okay, yes.
was nickel. Okay. What happened was there are two rival exchanges for the metals industry. Okay. One is the CME, the COMEX, and the LME. Okay. Okay. Now, all right. And the LME, okay, the Chinese bought the LME. Okay. And when they bought the LME, there was a big manipulation in the price of nickel. And it gave the exchange a really, really, really bad name. And a lot of people started to move away from that exchange okay, because it does trade, you have to be a member to be in the ring there. And the biggest members are, the Power Clays, all the big boys. Okay. The seats are very, very expensive. But point that I'm making, all right, what the public should also understand is that when if you lose faith in an exchange, then you're gonna lose faith in the market. Okay. All right. And that's the biggest that's why there are things called circuit breakers. Okay. So if the market goes down too much, they halt trading. Or let's say there's a really hot initial public offering. Okay. All right. And it goes up too fast, they halt trading, or down too fast.
I've actually heard that as some people say, oh, the market, some people who think the market is getting quite frothy, whether it's the Dow Jones or the S&P or the NASDAQ. Some people who say it's getting too frothy and it'll just crash tomorrow. And they've been talking about this doom and gloom sometimes for a year, 2 years, and it still hasn't happened and it's reaching new highs. And even their justification is, hey, even if people think there's going to be a flash crash, because it's algorithmic driven, there's these short circuits in place which will stop that from happening. So your investments aren't going to vaporize overnight because they've realized that the algorithms are trading too fast and everything's going downwards. There'll be a short circuit to cut it off for people to cool down, put those algorithms, if needed, back in place for humans to look at those. So you're not going to lose all your money overnight. Is that right?
I mean, it's called the rise of the machines. Okay, the rise of the machines. Okay, all right, because believe it or not, you know, over half the transactions that happen in the global stock markets happen away in dark pools and in other venues. Very interesting. Okay. I'll explain that. Let me explain that to the public. They may not understand what a dark. Think of it like this. You go to your bank, wherever your bank at ANZ, Bank of America. Okay. And you want to take a dollar and convert it into a US dollar and convert it into an Aussie dollar. And that transaction, okay, and you look at your little computer screen, it's good for approximately 1 minute. Okay. So they're matching a buyer and a seller internally. Doesn't even hit the street. Okay. It's the same thing at a firm like JP Morgan. I've got one client that wants to sell 10,000 shares of Microsoft. I have another customer that wants to buy 10,000 shares of Microsoft. Those trades are matched internally many times. Okay. And that's the same thing at, like the JP Morgans of the world, the BlackRocks of the world, the Vanguards of the world, the biggest players in the world. Okay. A high percentage of their volume is internal and they can make a nice spread on that. That's why they make the type of money that they make.
Yeah, that's exactly right. What you said there, the spread, because for every long you've got to have a short. Somebody's on the other side of the trade who's buying that. Unless I've heard in some derivatives, at least when it comes to the metals markets, not so much the gold and the silver shorts. You use the word manipulated there. Do you think the metals, those two metals, could be manipulated? Just an opinion. It's not that it's true. Who knows?
The justification for a lot of things is if there are more buyers than sellers, the price could be whatever the price could be. Okay. That's why, um, the, the float is very critical. Okay. When people have shares, okay, how many shares are out there? If there's 1 million shares issued at 5 and there's $100 million of buying power, the stock could be $150 in a millisecond.
Yeah, it's demand and supply, essentially. Yes.
Exactly. Okay. And many times the public doesn't understand what a short is. And the only way to explain that to an investor Okay. You see, because an investor thinks, how can you sell something you don't have? Okay. The idea of a short, they don't understand that, which is reasonable. Okay. Which is very, very reasonable. The best way that I always describe it is you're making a bet, and I hate to use that word. Okay. But you're speculating that something's going to go down. And if it goes down, you make money. If it goes up, you lose money.
Speculating is a good word, yeah, because speculation and investing are two totally different concepts. The way I see it is my parents or my grandparents used to invest. They used to buy shares of a company because they believed in what the company did long term, and they were proud to hold on to shares of those companies. I once upon a time worked for G Money in New Zealand, and they just told us, "Oh, if you bought in the 1900s, you'd be a millionaire, even if you had held just one share." And I think in today's world, also, it's a little bit of that. Is the investors who are doing that long term. There's a lot of speculation also because the way I see even with cryptocurrencies is some of the shares, the Mag 7 on the S&P 500, let's say, for example, because everything is index funds and stuff like that now, and global capital also moving into it. People are buying it to sell it at a higher price. Do you think that is also something that's become a market mania or a market psychology lately with computers and fast trading?
Of course. I mean, and that's part of it. Okay. You see, as markets get more efficient and there's more speed, all right, look at just historically, look at how endorphins work right now. Speed, TikTok, okay? Speed, 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 okay? All right. But what you need to realize with markets, markets get efficient. In the very beginning, when I first started, okay, just think about this. Okay, IBM used to trade at 100 on the bid and $100.50 on the offer. A 50-cent spread on one of the most liquid stock, 50 cents. Now you want to know. Now they're in decimals. Okay. All right. Markets get efficient. People get efficient. That's why every market gets efficient. That's why it's a market. Okay. And as it gets more efficient, it becomes much more complex because the margin fall. You like there's what when a firm says, "Hey, you zero commissions," how could they be working for free? Of course they're not. Okay, there's so many different ways. Okay, that people can capture a spread in today's world. Okay, um, when I click a button and I route that transaction to Goldman Sachs, they pay me to that. It's called payment for order flow. All right, because that's why a big company, let's say like, Morgan Stanley. Okay, they bought a company called E-Trade, and who did they buy it from? They bought it from Citadel. Why did they buy E-Trade? Because they needed the order flow. They wanted more customers. Okay, they wanted the lower hanging fruit, like the Robin Hoods of the world, firms like that. Okay, uh, that's how big a demand that is. That it's been gamified almost.
It is being gamified because that's what's happened now. Like an Uber or an Uber Eats, what they do. They take a clip from both ends and they just connecting the buyer with the seller.
Right. I mean, it's gamified, and the idea that you could open up an investment account with a credit card is a that would never that would never happen. Okay, all right, but it happens today, and I don't condone that. But it's just something that we don't do. Okay, all right, but there are firms that do that, and I don't condone but there's a reason why. Okay, be- you have to start with a reasonable amount of capital.
Exactly. And that's what you said. Even when you get in investors, they're going to have a certain net wealth. So you know they understand the markets, they know what's going to happen. There's risk and reward. And they're not exactly putting in capital on their credit card just to have a sleazy bet to what's going to go up or what's going to go down. You're working with real investors who understand markets, who want to be on the cutting edge of how can I make my capital grow.
How they can get think about it. Okay, in the 90s, like 91, you could actually go to a bank, have a CD, a certificate of deposit, which is insured by the bank, and get 12%.
Yeah, term deposit. Yeah, yeah, yeah.
Okay. Now you're lucky if you can get you put your money in Switzerland. Okay. Interest rates are cut to zero. Okay. Meaning you get nothing. As a matter of fact, it costs you money to keep the money there. So what the market's telling you, people are always looking for yield. All right. And that's what's happening. I mean, that's why when you see, let's say, real estate's a great investment, but it's always in the buy. Okay. It's always in the buy. Okay. It'll always have an interest. I mean, when you saw, all the properties that have problems in China, obviously they're worth something, but to who? All right. And those are the complex things about property. Property, when and remember, property trades on the exchange. You can buy a real estate investment trust and have, get yield and own, 50 shopping centers if you own some shares. All right. So remember, the market has everything. Today, you don't even have to buy a Bitcoin. You could just buy an ETF. You can go to your bank. You don't have to have an electronic wallet. I know if I have my money in my bank, I can pick up the phone and speak to someone. All right. I think the other thing that you've seen, what investors just hate, okay, um, is you've got institutions out there, but I'll use a perfect example. Okay. Google. Let's say you have an account at Google. Try to call them up. You'll never get through. Never. You can't speak to anybody. I mean, all right. And there are other institutions out there where and I'll say this and I have no problem, like a Coinbase. They don't take phone calls or things like that. You have to do it via email. Okay. But you do know, and all consumers know this. Okay. When you lose your credit card, okay, all right, you might have to stay on hold for 40 minutes and you might have to speak to somebody. Okay. But you actually can speak to someone. That comes back to what? Comfort and credibility and trust.
And the personal touch, obviously. Otherwise, it's just a chatbot you're talking to, and it gets frustrating. And
Right. It's a service oriented business. I mean, like the philosophy that we have at our firm, we want to meet our customers face to face or via Zoom. Okay. We do. Because there has to be a human touch. With anything.
people are trusting you with their capital. You obviously want to see who you're dealing with, and I think that is it. Trust is something with artificial intelligence and too much technology in place. People are losing. And you said your firm obviously does face-to-face business, so you can meet who you're investing with. Talking about your firm and your investment philosophy, now I want to talk on certain specific market segments and stuff like that. You did mention people going out the risk curve, obviously, with the interest rates. I know in Japan and Switzerland were negative interest rates. I know during just after the global financial crisis as well. So central banks pushed people out the yield curve and they had to invest in whether it's real estate or markets or whatever it is. What is your view on the recent, well, obviously, I think the FOMC meeting coming up mid-September and Trump saying, hey, Federal Reserve, we need low interest rates. There's no inflation in the economy. And the chairman of the Federal Reserve is headstrong and he's saying, no, we haven't quite reached there yet. What are your views on what's going on? Does the US economy need interest rate cuts? And is Trump going to get what he wants come September?
Let's talk about that. Okay. In two ways. In two ways. Okay. The first thing that people need to understand is if there's $1 in your checking account and you write a check for $5, your debit $4. I mean, your overdraft. The world is basically overdraft. There are very few countries that aren't overdraft. Okay. It's called a deficit. Okay. Very few. Now you need, and this is very specific. Obviously, and this comes back to tariffs. All right, because it's like this. If the U.S. goes down, all the lights are shut off. Okay, they just are everywhere. So that when the deficit is so increased, all right, and so inflated, all right, you know, the U.S. right now with the current administration is saying, hey, you got to split the bill now. Hey, you got to pay. If we didn't pay, well, you got to pay. All right. So it's a vicious cycle, and there's a lot of devil in the detail with all the tariffs. It is. There's a lot of devil in the details. Okay. And as far as rates, you know, historically speaking, remember what is Trump and where does he come from and all the people that he's surrounded himself with. Okay. All right. Trump, he's a real estate guy. Of course he wants lower interest rates.
He loves debt. Yes, that's how he's built his empire.
Of course he wants lower interest rates. And when you have small populations, and this is very critical to understand, okay? There's what, 40 million people in Australia, give or take? Something like 40.
Yes.
So if the RBA cuts rates by a quarter, there's 40 million people. It's a teeny, it's minuscule. Okay, all right. It's the only rates that really matter are the U.S. rates. Okay, and China and the EU. Okay, those three. Okay, everything else. Okay, Latin America, it's in its own little bubble in a way because they've always had real serious inflation problems and printed a lot of money. Until now, you have countries like Argentina, okay,
Relay.
that have yeah, that have really turned it all around. Okay. But the moral to the whole story is this. There is inflation. I don't care. When there's a disconnect between Main Street and Wall Street, it's the little guy who feels the inflation. Even the big guy feels the inflation. All right. If you're a big property owner and you're in an adjustable rate, okay, and let's say the property is worth, 50 million and you're in an adjustable mortgage rate, that extra three quarters of a point or a half a point could kill you. All right. I mean, and that's and people, it's really about numbers. It's truly about numbers.
So with Trump, what you were obviously Trump is a real estate guy. He borrowed a lot of money and built his empire. Obviously, he's also declared bankruptcy a couple of times. So we understand his perspective. And obviously, for the listeners to understand, the U.S. has a $37 trillion debt book, which the higher the interest rates, obviously, the higher it's almost 1 trillion being spent 90 days with the budget deficit and 1 trillion in interest expenditure. So Trump being the president, he wants lower interest rates, obviously, because less money goes out the door, handed out to maybe even foreign governments like China who own the US treasuries and stuff. But coming back to the question with the Federal Reserve, why do you think there's a lot of people, market commentary out there that the inflation's really not there, the inflation's come back. In fact, in US, the job numbers are going down. Unemployment rate is ticking up. The economy is really not as strong as people think or the Federal Reserve thinks it is. Why is he not dropping interest rates? So do you think come mid-September, the next FOMC, he will now because the pressure is getting too much on Fed Powell?
The market's trying, a market will always fix itself. That's why it's a market. The markets forecast things. And he's under pressure right now. All right. And remember, his term is up.
Almost up, yeah, next year.
Almost up, right? Almost up. Okay. So everybody is putting their hat in. Okay. All right. Meaning you've got, hawks, they're dovish, this and that. Okay. And that's the reality.
The reason I asked you that, Steve, was also recently in Australia and New Zealand, we've seen a split where the RBA and Z, the board was split half-half to what should be the interest rate, and then they cut it by 25 basis points. And in New Zealand, in Australia recently, the same thing has happened, is the board is disagreeing. They have 50-50 split, and they could not agree on maybe a 25 basis points or a 50 basis points. So obviously those economies are suffering. The consumer is feeling the pain, and they've dropped interest rates. So has Canada, so has Switzerland. The US is the only one holding out. And some of my listeners will understand that the interest rate differential has an impact on the US dollar and the currency, and everything's connected, as you said. Do you think he's trying to hold up the US dollar? Because a lot of what Trump is and best into talking is affecting the US dollar going down.
Listen, I've seen the dollar against the euro, okay, at 135. Okay. It's 160. And I've seen the dollar against the Aussie when it was inverted. Okay. Where the Aussie now, okay. So, I mean, the world's not going to go out of business. Okay. Right. It's not going to go out of business. Okay. It's called a cycle. Okay.
Yeah. Do you think it's economic or political? Has it gotten to that stage where it is still to do with market dynamics, or is it getting
It's
towards?
a combination of both. That's a harder one. No, I mean, it's that's a really hard question because, today, I'll give you a really interesting, in the past, first of all, the president of the United States has never ever gone on Squawk Box, but Trump did. Now that says something. Okay. All right. And before Obama, the president of the United States used to only speak to the country maybe 5, 6 times a year. A year. Okay. They have press conferences every day, and it's the world has changed. There's a new normal, okay, which is the advent of speed. Okay, it went from a fax machine. And who uses a fax machine today? All right, that was big technology. Okay, in 1989. All right, you know.
Yeah, yeah. I know you are hard for time, so I want your view on cryptocurrencies and what's happening in that space with the Genius hack, quickly.
Okay, let me say this to you. It will go higher, but there's going to be extreme volatility. All right. And why will it go higher? Okay. Because it is manifested itself as a legitimate asset class of some sort. Okay. All right. And the reason why you can say that is you're seeing that it has relationships. Okay. What's the relationship between the BTC and a 2-year note? You're seeing those relationships. What's the relationship between BTC, Ethereum, uh, and Solana? Okay, versus 10 ETFs. They have relationships now. All right. There are relationships developing, just like there's a relationship between West Texas Intermediate crude oil and Brent crude oil. They have, all right. So the market is actually maturing. That being said, okay, it will have big spikes of volatility, and people could add that. And the Genius Act is allowing the consumer, okay, and the U.S. is leading the way with that, meaning that it could be in their 401k and in the retirement plan. Okay.
One question for you, Steve. Do you have a motto in life?
Do I have a motto on life? Yes. Live and let live. You know, live and let live. You know,
Hey, Stephen, as you know, I have a financial consultancy called Success Simplified, and I love asking my guests this. Steve, how do you define success?
um, success is measured by understanding failure. In order to be successful, you have to have a lot of failures. And every day, okay, I lose money in the market, but I'm always, my fund is up because understanding that no one's going to be right 100% of the time in anything. All right. So success comes with a dedication and being honest with yourself. Okay. You need to be honest with yourself. Okay. And that's the hardest part of anything. Okay. You know,
Thanks for that. And since you've given us so much time, and my listeners would want to learn about you and the firm, Balfour Capital Group, where can our listeners learn more about the firm?
well, you can visit our website, balfourcapitalgroup.com. Okay. We also have a YouTube channel. Okay. That'll show my press releases and you can just reach out. And it's just right there on the site. We have offices, basically all over the world. And we like and enjoy speaking to investors. Our next big conference, we have a big one in Romania, in Bucharest. Okay. That'll be on the 3rd of September. And we have a big one in Sao Paulo, Brazil. All right. With high net worth individuals and investors. And I'll be at that conference. Okay. With my employees that are on the ground there. So we're global.
And if people want, they can jump on the website, see the specific location, and obviously reach out to anyone who's local for them.
Sure. Absolutely.
All right. Hey, Steve, thanks for your time. It's been a pleasure, mate. Thank you.
Thank you, person. Okay. I really enjoyed it. Okay. Take care.
Thank you. Thank you.
You're welcome.